taking control of your retirement with an SMSF. Stop thinking, start planning. So today we're just going to go through what retirement looks like in general, and then also if you are considering a self-managed super fund, what to think about if you do want to take more control of your retirement. My name's David Maddock. If you haven't met me or spoken to me before, I'm based in our Geelong office here at Apt Wealth Partners, over 20 years in the industry, qualified to provide advice to all aspects of financial planning, but specialise in SMSFs and retirement planning and making sure people take care of their financial future. So just a bit of housekeeping today. This is recorded. You will get a recording of this presentation. So if there's something that you have missed, you can go back and rewatch it. Happy for you to share the recording with other people that you think may get advantage of reading this or listening to this. And also, we've got a lot of information on our website about what we're discussing today. So if you go to the Apt Wealth website, you'll find a lot of content that also hopefully help your understanding of taking control of your retirement. Important just to note, this is general information today, so it isn't personal financial advice. If you are wanting personal financial advice, we can provide that. That's what we do. But today is just in general information only for you to start thinking about retirement. So what are we going to talk about today, or I'm going to talk about and go through taking control of your retirement with an SMSF, stop thinking, start planning. So this is just a bit of a call to action for those that are thinking about retirement, and then going over the few of the key areas that often people are asking questions about. So how much do you need in retirement? What's your retirement going to look like? Understanding your investments, and when I say investments, superannuation predominantly in retirement, maximising superannuation, and then what to consider specifically around a self-managed super fund. That's what an SMSF stands for, if you haven't heard of that before, and how Apt ourselves can assist with an SMSF, and why choose ourselves to partner with in retirement. So one of the things that we like to use with clients and make sure for retirement at the end, you'll regret the things that you didn't do instead of the things that you did. So retirement really is that point in life where hopefully you can start doing maybe some of those things that you've held off on, and tick off that bucket list items in retirement and having a happy retirement. So obviously, those that are tuned in today, you're already thinking about retirement. Obviously, that's why you've joined today. Statistics are that 1 in 5 Australians think about retirement daily or often. So it's obviously depending on your stage of life, you might be thinking about it more often than that. It might be a regular occurrence, but depending on your stage of life, you're obviously going to start thinking about retirement at some stage. So then some of the key questions will hopefully answer a lot of those today. When is the time right? Capital gains. Will I need a pension? How much will I need? Aged care. Will it last? The lifestyle. What can I afford to live? Or how do I afford to live in retirement? So hopefully we'll give you a bit of an idea of what that looks like today. So the big question that often people ask is, how much do you need in retirement? So how much do you think that you need to retire, and obviously retire comfortably? So some people think 300, there's 500, 750,000. And I know growingly people think, well, I need to have $1 million in superannuation to retire, or obviously potentially a lot more than that. So the statistics are that, and this is from the ASFA, which is a retirement standard that they come out on a regular basis last year in 2025. There are a few assumptions, obviously, this, of course, so being age 67 and retired. For a couple, it's 690,000 in superannuation. For a single, it's 595,000 seen as a couple in retirement. And that is your income being generated from superannuation, but also supplemented from at least a part age pension from the government. So to give a bit more clarity of, well, what does that comfortable lifestyle look like? In that top left-hand corner there, living a comfortable lifestyle. The average is seen for a single person, 53,000, a little bit over per annum, and for a couple, 75,000, a little bit over there per annum. Now, just to, again, a bit of clarity on what that covers and what that assumes, there are a few assumptions that you have no mortgage, you're debt-free, that you own your own home, and that you don't have any dependent children, that you are empty nesters that aren't financially dependent on you. And it does afford some holidays, but if you're wanting a regular European vacation of, $20,000 plus per annum and annually, well, you're going to have to most likely need a higher income than that. But 75,000 for a couple to 53,000 is what's seen as a comfortable lifestyle for most Australians, so that they can at least afford to live, have some holidays, pay bills, and live a relatively comfortable lifestyle. They do come out with a modest lifestyle. So this is a lower end retirement that's seen as 34,000, just under 35 for a single, and around the $50,000 mark for a couple. That would be a bit more of a tighter budget, obviously. But we ideally try to get as many people as possible and ideally have that comfortable lifestyle. And again, this is an average. So some people will say, well, 75 isn't enough, and 75 as a couple, and for a lot, we'll say that's plenty. So it's going to be up to what level of lifestyle that you want to live in retirement, but that is going to give you a good idea of what you should be thinking about. As I said just a moment ago, retirement's going to look different for everyone. You want to live your life to the fullest, so it's important to understand what your goals and lifestyles are and to create your personal plan of what you as an either single or a couple are trying to achieve. So some of those things can be, well, when do I finish work? Do I just phase out of work over a period of time? Do I downsize my home? Do I upgrade the car? And how often you're going to do that in retirement? Traveling, what travel looks like for you, whether it's caravanning around Australia is predominantly what you're wanting to do, or whether it's more overseas holidays, or a bit of both, where it's caravanning every year and maybe every 3 years an overseas holiday, and then helping out children. The bank of mum and dad is real, so it is a thing there that clients that are wanting to help out their children financially, adult children, can do it, but also making sure that doesn't impact detrimentally on their own retirement and planning for that. So going back to the retirement standards, and keeping that in mind, and the two type of retirees that are out there, we really like to work with clients that are their superannuation, their investments stay on the blue line. And that blue graph is that there will be periods of economic uncertainty, share market volatility throughout retirement. So your superannuation balance and other investments will go up and down over time. But ideally, as much as we can, preserving capital, and that's the blue outline there is preserving, or blue graph is preserving capital and living as much as we can on the actual earnings, interest, dividend, rent from your different investments to supplement or to provide for retirement, and rather than eating into the capital and giving you that comfortable lifestyle in retirement. The red graph is really highlighting if you are eating into capital, that you are going to find that your superannuation balance, share portfolio, whatever it is that you have and are planning to use in retirement to finance your retirement, will drop over time. And you can see a bit of a compounding effect of if there is market uncertainty and you are dropping and eating into the capital during downward markets, how that can eat into your balance and obviously create stress in retirement. So ideally, if we can stay on the blue line rather than the red line as much as possible, that means you're unlikely to run out of money in retirement. So how do we work together? Personalized strategies to help you achieve that peace of mind and that lifestyle that you desire. So obviously, to stay on that blue line, those clients will have and always generally do have more peace of mind and have that desired lifestyle, and that's what most people are wanting, well, pretty much everyone wants in retirement. So there is a bit of a checklist you'll see on the right-hand side there that you should really be thinking about ticking off in the lead up to retirement as part of that planning. So can you maximize your superannuation? Is your strategy tax effective? Are there any government benefits which will help supplement your income to reduce the burden of living costs? Big one is, can you survive market downturns, preserve your capital in retirement, and as much as possible, again, ensure that your income lasts a lifetime. And lastly, hopefully no regrets about retirement. So where does your money, your income come from in retirement? So there's going to be, for a lot of people, a number of sources. We'll start from left to right. So about 85 to 90% of Australians that are over 67 do get at least a part age pension from the government. So there is the government support of the age pension, depending on where you fit under the income and asset test. There's superannuation, which generally what most people will be doing at retirement is converting their superannuation balance across to a pension to replace income from employment. Cash savings. So it is always important to have a cash buffer and some savings there to cover for emergencies and short-term cash flow needs in retirement. And on the far right, last of all, will be investments. So investments is really anything outside of superannuation. It may be that you have some share investments, which you're getting a dividend every 6 months. It could be a rental property where you're getting rental income, or some type of investments that are hopefully generating income, because we really want income producing investments and assets in retirement to help cover your salary or income that's ceasing from work. So let's talk a bit more about understanding your investments in retirement, and then also that is also an advantage of an SMSF, of knowing and taking a bit more control of your investments in retirement. So I've been doing this for 20 years now. This graph is not quite 20 years, it's 30 years, but I know enough to know that there, at least over the next 20 years going forward, if I go back, look at the past 20 years, there are going to be at least two major economic events, I would assume, that you have to assume that will impact and that will have a downturn on markets. The last 20 years, those two major ones have been the global financial crisis, which is almost about 20 years old, 20 years ago now. And then most recently, the last 5 years was COVID. And you can see in 2008, the big drawdown because of the global financial crisis. And then you can also see in 2020, when COVID first hit, those red dots, the big drawdown initially in share markets because of COVID. But if you look at, say, 2020 as an example, it was in March 2020, it was down 37%. By the end of the calendar year, the market had rebounded a fair way. It was actually only down 1%. So one of the key things is not panicking in retirement, and also understanding, particularly when you're drawing upon your investments in retirement, having a drawdown strategy. So actually having a control of when you are drawing down on investments if you need to. Ideally, if it's got income generating investments, we're not having to. But if you are having to sell some investments or redeem some investments, doing it at a time where ideally the market's not down 37% like what happened in COVID, or down close to 50% during a global financial event. But if you have a look, most years, 22 out of the 30, the years have ended in calendar years have ended with the share market being in positive territory. So, and the average median return has been 11%, and intra-year drops can be as much as 14%. So over a 12-month period, the share market will be volatile, and then you'll have those extreme events that happen every 20 years, or maybe, more frequent than that. We don't know when they're going to happen, but we know that there are going to be volatility and market downturns throughout retirement. So what does a self-managed super fund allow you to do, or taking an approach where you are a bit more control of how your money invested? Well, you can invest directly in investments rather than just a pooled, say, balance fund. You can own Commonwealth Bank, Westpac, Google, Medibank Private, Microsoft, these known companies. You can invest in these companies and hold those companies and actually control when you are drawing down upon those investments. And to give you an example, Commonwealth Bank was down around about $60 a share during COVID, and it's been well over $150 now for the last little while. And that if you have sold during COVID to fund retirement, then you've lost that capital if you sold during that period of time. If you're able to hold throughout that period of time, live off the dividends while your portfolio balance, your superannuation balance will have maintained itself, and hopefully potentially you can still grow in retirement to maintain capital, rather than just automatically selling out of investments throughout an economic downturn. So you can take a lot more control, draw down on your investments through a more tailored approach, and to your retirement. And that's knowing what you're owning and having control of when you're drawing on your investments. So how can SMSF help manage retirement? Well, it gives you greater control, as I've just said, in drawing down your investments in retirement, preserving capital. You can get the government guarantee on banks and term deposits up to $250,000. So every bank has every major bank in Australia has a $250,000 government guarantee, and that includes self-managed super funds. So if you had $500,000 in 2 term deposits within your self-managed super fund with 2 different banks, you've got that $500,000, so two $250,000 term deposits, government guaranteed. So there is some protection there on deposits as well that helps preserve your money in retirement. You can decipher between income generated of your portfolio and the capital growth of your portfolio. And that's important that actually, if okay, of getting income of about $50,000 a year from your portfolio, you're wanting a comfortable lifestyle of $75,000. So they might have to sell down $25,000 worth of shares from time to time. But you can actually know, okay, I'm generating an income of $50,000. How much then from time to time do I draw upon my other parts of my portfolio if needed to make up the $75,000 that you need for a comfortable lifestyle? So there's a clear difference between what's the income of the portfolio and what's the capital growth of the portfolio. And we ideally want to live off the income as much as possible and let the portfolio continue to grow. You control the dividends and distributions. Most of the time, you're going to not reinvest in retirement because you need that income, but you can then redistribute those distributions, being dividends and distributions, back into further investments, particularly in the lead up to retirement. You can keep buying and preserving your capital by reinvesting should you wish to. You can control when you are selling down on any investments and realizing any capital gains. And this also, I won't get too much into this because it does get a little bit more complex, but if you are planning to retire and you're wanting to redeem some investments, there can be some advantages of going to a pension first, then restructuring your portfolio, because you can have up to $2 million in superannuation tax-free. And if you are going to realise some gains, well, you can realise that in a tax-free environment in retirement rather than pre-retirement. So again, you can minimise tax and preserve capital by minimising any impact of tax on realising any capital gains or any drawdowns from your super. So it is very clear from a tax perspective and planning that you can really plan for how you want to access and draw upon your superannuation in retirement with an SMSF. You also get the full advantage in retirement of the franking credits generated by your portfolio. So if you're invested in Australian shares, and I said Commonwealth Bank before, they have a fully franked dividend. That fully franked dividend, if you are in a pension phase, 100% tax-free in retirement, you get a tax refund at the end of each financial year, being the franking credit refund, which again helps top up the income that you're getting from your portfolio in retirement. A self-managed super fund if you wanted to, and it has to be really thoroughly thought through. But one other thing, you can invest in direct property, either residential or commercial property, in a self-managed super fund that may suit your needs. But you really do need to get advice if it's going to suit you in retirement to do that. So giving a bit of an example of using a self-managed super fund to survive a global financial crisis, a GFC 2.0 scenario. We've got two different clients here. We've got Max with a unitized fund and Jane with a self-managed super fund. So the scenario here, the share market drops by half. So again, roughly what happened during the global financial crisis, and then takes 5 years to recover over that period of time. So the difference between the two clients is Max has a unitized fund. So he has a balanced fund where about 60 to 70% of his portfolio is in shares, and then 30-40% is defensively invested. So both clients are taking $6,000 per month out of their super to fund their retirement. So, and then Jane's also taking $6,000, but she can actually choose where she's taking the $6,000 from per month. So she can draw upon the dividends, interest, the cash component, rather than automatically selling 60 to 70% of her shares or property growth portfolio of part of her portfolio each month. So in Max's scenario, he's taking $6,000 per month out of his super fund. By the time that recovers, the market recovers, his balance is $375,000 because he's not been able to preserve capital, and he's been selling out of his portfolio each month to fund his retirement of $6,000 per month. Now, I didn't say, and I should say, this is assuming both starting balances of $1 million each. Jane also has taken her $6,000 per month, but has a drawdown strategy of taking from cash defensive investments first. Income and is coming from also interest and dividends, and then eventually may have to sell some shares to fund her retirement. But she's doing that in a time where the market has rebounded quite significantly. And though she hasn't quite got back to $1 million, she's still at $838,000. So $463,000 better off by having a drawdown strategy and allowing the likes of like a Commonwealth Bank to rebound, and before having to actually sell down in a downward market where the market's dropped 50%. So that's part of drawing down on your superannuation, but obviously you need to get your money into superannuation in the first instance. So there are some ways of tax effectively saving for retirement and maximising your superannuation. So firstly, why is superannuation a good investment? Well, it is taxed effectively, and it is reduces your personal income tax if you are putting in concessional contributions. The earnings are taxed at a maximum of 15%. There is a forced savings element to it. So obviously, if you're an employee, you are getting 12% from your employer every year of what you earn is getting paid into superannuation, and that's happens automatically, or should be happening automatically, and that helps you live for today and plan for tomorrow, which is a bit of a catchphrase that we use here at Apt. It is also an estate planning tool. You have beneficiaries that can also you receive your superannuation upon you passing away. It can provide a tax-free income after age 60 in retirement, and that's up to $2 million per person at the moment. And it can also be used in SMSF, can be used to support your business by investing in a commercial property, which can be, if that's going to be part of your investment strategy as well. If you wanted a property inside of your superannuation as part of your retirement. So superannuation contributions are broadly broken down into two categories. In the blue, there's concessional contributions. So that's the 12% that I was just alluding to that work pays. That is capped at $30,000 per annum at the moment. So if your work is paying $10,000 per annum, you can salary sacrifice or put a concessional contribution of another $20,000 in for the financial year, up to that limit of $30,000. That is the tax effective part, that anything that goes into superannuation is taxed at 15% on the way in, but also helps potentially any salary sacrifice reduce tax at your personal marginal tax rate. And the average Australian's on at least 30% tax bracket, so it's a 15% tax saving straight up with any contributions into superannuation. In the yellow box, you have what's called a non-concessional contribution or personal contribution. They can be the government government co-contribution, the $1,500 per annum that you can get into super from them, depending on your income. Personal deductible, non-deductible contribution. So that's, you've just got some money outside of superannuation, you want to put that into super. And there can be the benefit of a spouse contribution. If you have a low income spouse, you can put some money aside for them in super and claim a tax offset for the spouse, but that goes all towards the non-concessional side of your superannuation. Now, the annual limit for that contribution is $120,000 each financial year, as long as your balance is below $2 million. And you can use what's called a bring forward provision of or a catch-up contribution. So that's $360,000 being 3 years of $120,000 in one financial year up to age 75. So that's how you can get your money into super. The concessional contributions, this gives an example of the tax advantage. As I just said before, most people, and this includes Medicare levy as well, are in that $45,000 to $120,000 income. So you're paying tax at 34.5%. The tax rate on concessional contributions is taxed at 15%. So there's a 19.5% tax saving on that contribution or any additional contribution that you may be salary sacrificing. And then you can see that, 120 to 180,000, so 24% tax savings. Between 180 to 250, there's a 32% tax savings. If you are over 250,000, that does reduce because there's what's called Division 293 tax, so that you don't get quite, as a high income earner, you don't get quite the same level of tax savings. But look, most people are going to get quite a significant tax saving. For lower income earners below $45,000, there isn't the same tax savings or as much of a tax savings, but there are that personal contributions and other contributions like the government co-contribution, spouse contributions that can help boost your superannuation as well effectively. So superannuation phase, it's important to understand the different phases as you do transition to retirement. So if you are working up to age 60 to 65, depending on when you decide to retire, you're seen as the far left-hand side in accumulation. Anything that is earned in any tax that needs to be paid in superannuation is taxed at 15%. As soon as you retire and meet a conditional release, you can transition your superannuation balance to a pension account. And that's that middle section of the graph or the slide there, 0% tax. And essentially that's up to $2 million. And you'd normally do that at retirement because that's where you're going to get a tax-free pension in retirement and also pay no tax on any realised capital gains in retirement. The only proviso when you start a pension, either from 60 onwards, is that there are some minimum pensions that you have to abide by to have that tax-free environment. So between, if you're far right, you'll see if you're under 65, 4% is the minimum that you have to take. So simple maths on that. If you have $1 million in a pension account at retirement at 4%, your actual least minimum pension you have to take is $40,000 a year. You can take more if you need to, but that's the minimum. And say from 65 to 74, you have to take a minimum 5%. Again, on $1 million, that's $50,000. And as you can see, that incrementally increases as you get older. The reason being is the laws are that you can have $2 million up to in a tax-free pension environment, but they don't want you leaving it in there for the rest of your life tax-free. They do encourage or do force you to draw upon it in retirement. And again, that's why the drawdown strategy of understanding how you're accessing your money over time is important. This is a bit of a busy graph, which I'll go through with you, but just something to be aware of, because you'll need to ask, more specific advice on this if you are looking to take advantage of it. But there is what's called a catch-up contribution for clients that are got superannuation balances below 500,000. So basically what it means is if you have a look there, you can go back in previous financial years and use any unused concessional contribution cap. So if you recall, I said the concessional contribution cap this financial year is 30,000. If you haven't maximised that in previous financial years, though, you can use those catch-ups to make a larger contribution claim deduction. So if you go to the far left-hand side, the cap used to be 25,000. The actual contribution in that year was made was $15,000, but you'll see that orange amount, $10,000 wasn't used, and that $10,000 can be used in future financial years to, reduce your tax, and that carries forward over 5 years. So the next year, financial year 2022, the cap was 27 and a half, but then you add the 10,000 you didn't use the year before, that takes up to 37 and a half. And that can be quite powerful because that, if you haven't used that and that's growing, you can actually then, if you have a large income year or realize a large capital gain in your personal name and you have less than $500,000, there can be a significant tax saving by creating quite a large tax deduction. In the 25 year, in this case, it was $107,500 that could be claimed as a tax deduction if you put that money into superannuation. But there are some specific criteria that you have to meet, so it's worth getting advice on that. I've alluded to this just previously in earlier slides. Take advantage of every opportunity. Some quick wins. If your income is below 62,000, you can actually put some money into superannuation, and you can get a government co-contribution to match from the government to match your contributions into super up to $500. So they'll match if you put $1,000 up to $500, so you can get $1,500 into super in that instance. The spouse contribution, if you've got a low income earning spouse, income below $40,000, and you put a $3,000 contribution in, again, you can get a $540 tax offset. So put essentially $4,000 into superannuation to get a bit over $1,000 overall benefit for low income spouse or low income people. There is also the criteria if you are downsizing in retirement, what's called the downsizer contribution. So anyone over 55, again, if they meet some certain criteria, the main one being in their principal home for greater than 10 years, and they do downsize their home in the lead up to retirement or during retirement, you can put a lump sum of $300,000 into superannuation, and that doesn't count towards the non-concessional caps that I was talking about before, those 360,000. So that's something to look at if you're wanting to get more money into superannuation and thinking about downsizing. The only thing to be aware of, the home isn't assessed for age pension purposes. But if you free up $300,000 and put that into the bank or super or wherever that might go, it is counted as an asset then for Centrelink age pension. So there can be a Centrelink impact, which needs to be considered. Okay. Now, using a self-managed super fund to protecting your beneficiaries. So self-managed super funds can be quite powerful for estate planning, but also all super funds will have an aspect of estate planning that you need to be thinking about in retirement, because the reality is most people are going to have a superannuation balance in retirement, potentially at death. And so upon death, what happens with your superannuation? Superannuation, if you look in the far left-hand side, we've got that binding death nomination. It's important to know that superannuation is not an asset, estate asset, and does not automatically flow to the estate or as per into the will. So that's important to know, because often people think, oh, we'll just get paid as per the will. It may not be the case, depending on what your nomination says with your super fund. So that being said, who you can nominate as a beneficiary, and commonly is the case, either a spouse or children. If you say nominated a spouse, your superannuation will go onto your spouse. It won't actually go as per whatever your will says. If you named your, say, adult children, they will inherit your superannuation and again doesn't form part of the estate. You can nominate your will. So you can say tell your super fund to pay your superannuation benefits as per whatever your will says, but that you need to stipulate that. It doesn't automatically happen. And with binding nominations, what we'd normally recommend, that's where normally you'd have two people witness that that's your wishes as how you want your superannuation to be paid. They are bound to pay out either your normal super fund or a self-managed super fund. It is binding to the trustees of the super fund to pay out the superannuation in that order or that instruction. On the far right, we also talk about the re-contribution strategy. I'll go about talk about more about this in a moment. This is really important because they'll say that or the government will tell you there's no estate tax. Well, that's not quite correct. Adult children can pay up to 17% tax on inheriting their parents' superannuation if they're not aware of that. So it's based on what's called the taxable component of the super, which for most people is probably going to be 80 to 90% of their superannuation is going to be what's called a taxable component, because that's what either their work employers paid into superannuation over their lifetime or anything they've salary sacrificed. So a large chunk of their superannuation or anyone's superannuation is going to be incur 17% tax if you don't take some action when paid to adult children. And that's what we call the action part is a recontribution strategy, which we'll talk about in a moment. So protecting your beneficiaries. So this is an example of the recontribution. So Tom and Jane, they're age 63 and have retired. For this analysis or this case study, we can assume that Jane has $720,000 in a pension. She's retired, all from her employer that was super guaranteed. Tom has 0% in his superannuation, so he didn't add no tax. He's probably self-employed. Sometimes self-employed people don't pay super to themselves, so he never was employed and never paid his own super, so he got to zero tax. So once Jane passes away, if they do nothing, and Tom passes away, so again, both of them passed away, it all flows on to the children. There's 17% tax on that balance, and that would equate to $122,000 in tax for that for Jane as a estate before paying on to her adult children. So most people, once are aware of that, well, we don't want to pay $122,000 if we can avoid it. And I actually did this for a client just this week, this exact strategy. And coincidentally, it was very close to $120,000 tax savings that we got for them in this instance. So that client that we did during the week and did this exact strategy, slightly different in that they both had some super, but what we did with a meta-conditional release, so Jane's meta-conditional release, she withdrew the full $720,000 balance and put it in the bank. And so that just sat there for a few days. And then as Tom and Jane are still under 75, and again, remember the contribution limits, they recontributed $360,000 back into super, and that was $360 into super for Jane. And we also added, though, this time $360 to super for Tom. So we split the superannuation balance, and that's converted the $720,000 from a taxable component of their super to 100% tax-free between Tom and Jane. So now the tax for the children when they inherit that is nil, zero. So they've saved $122,000, which would be a big win for the adult children because, I'm sure they'd much rather that than the other way where they've paid out $122,000. So that's a strategy that's definitely worth looking at in retirement, because a lot of people aren't aware that their adult children will pay tax. I'll just talk briefly on Division 296 tax. This might be something that you've heard of. If you haven't heard of it, you will be soon, but a lot of people are aware of this. This is the legislation that's currently before Parliament at the moment. The government has updated the proposal late last year for the Division 296 tax, which is the tax for superannuation balances above 3 million. At this stage, we're expecting that to come in from the 1st of July 2026. And essentially what that does mean is that there's going to be additional tax for super balances above $3 million. They have tiered that. So if you have a look there in the middle there, tiered tax rates apply. So 30% tax rate on earnings for balances above $3 million up to $10 million. So at the moment, the maximum is 15%. If it's in a pension environment up to $2 million, it's 0%. But if you've got a larger balance, not all of it's going to be in a pension account, and then anything above the $3 million is going to be at 30%, and that goes up to 40% at anything above $10 million. It's important to know one of the sticking points then why they changed the legislation. That second bullet point was that there was going to be what was going to be taxed at those higher levels was also unrealized capital gains. It's not the case. It's just earnings. So any dividends, interest above the $3 million. And the $3 million and the $10 million thresholds will be indexed over time with inflation. There was a change proposed, which I'm assuming will go through for low-income earners. There is a low-income super offset. The cap was increased from $500 to $810. So again, those income earners that are below $45,000, those lower income earners will get a increased offset on their super. So that helps those lower income earners maintain and grow their superannuation. Again, you see down the bottom there, it's important to know this is draft legislation. It hasn't been approved yet, but that will probably happen relatively soon. So I'm just going to talk a bit more about self-managed super funds in particular, what to consider when starting a self-managed super fund. So if you are wanting to take more control of your super, you might think, well, now what's the strategy? How do I go about it? There's, again, some things that specifically need to think about engaging with an Apt SMSF administrator. So we have accountants, that's predominantly accountants, but there are others out there that are SMS administrators. We've got a couple that we use here. We work very closely with them, but you do have to have an administrator that acts on your behalf with lodging your self-managed super fund requirements each year with the tax office and making sure remaining compliant. You have two types of trustees. So what's called individual trustee or corporate trustee. And if you're a corporate trustee, you do have to have director IDs. Again, we help clients with all of these steps and what's most appropriate for you. So the structure of your super fund needs to be considered. Then once you're setting up a self-managed super fund, it has an ABN, it has a tax file number, which is get registered with the tax office and that we apply for. You establish a trust deed, which is the deed for your self-managed super fund, again, that we establish on behalf of clients in setting up a self-managed super fund. You have to consider the SMSF investment strategy, and it needs to be a documented investment strategy, which we draft and help clients with. And then contributions and movements of super, they are tracked through what's called SuperStream, and that requires an electronic service address for your self-managed super fund. And then a couple of the more practical things are that you have to have a self-managed super fund bank account, and you do then roll over your current super balances into a self-managed super fund, and they get deposited into that SMSF bank account. Once they're there, they are invested based on the investment strategy and your investment goals and retirement goals. So some more things just before making the jump into a self-managed super fund that you should be considering and thinking about beforehand. There is an increased time requirement and documentation requirement. We manage a lot of that for clients, but you do still have to sign off on documentation, and you have to be aware of that and making sure that you're fine to sign off on more paperwork. The sole purpose test. So even though it's your self-managed super fund, and you do have greater control, it has to abide by the sole purpose test. That's part of the SIS legislation. So that means that basically the funds have to be used for retirement. It can't be seen to be used to purchase a holiday house that you're wanting. It can't be seen to be helping out kids, taking money out to help kids buy a home or anything like that. It's really for your retirement plans and your retirement purposes. A self-managed super fund must be domiciled in Australia. So we do a bit of work with expats, and expat Australians can't really manage a self-managed super fund too easily because they do have to be domiciled in Australia. The super fund has to be held and run in Australia. You do need to have an independent audit every year. Again, we help organise that, is independent of us here, but it does need to be audited annually. So you need to abide by, and it ticks off things like, is it domiciled in Australia? Are you ticking off all the compliance paperwork, and is it meeting the sole purpose test? That's part of the next bullet point, the ATO annual compliance, and that does need to be done in a timely manner. There are date requirements to have things lodged with the ATO. Insurance for members, as part of the strategy, you should be considering insurance for members, particularly if you have existing insurance in your self-managed super fund, your current super fund, and you want to set up a self-managed super fund. You don't want to accidentally lose any insurances before by rolling over to a self-managed super fund. And depending on your individual super fund, there may be other benefits that you should consider that you may be lost if you roll over to a self-managed super fund. But the main one would most likely would be the insurance benefit. All right. So how can Apt Wealth assist in managing your retirement and your self-managed super fund? There is a fair bit to consider with a self-managed super fund. Investing does start with choosing the right partner. We do partner, we have it either internally or do partner already with a number of professionals to making sure that your retirement is handled as seamlessly as possible. So what does that mean? So accounting, we work with accountants and SMSF administrators on managing your self-managed super fund, and that could be family trusts as well. That can be your personal income tax, all those sort of tax requirements. Wealth protection, we do have insurance advisors here if we needed to replace life insurance, income protection, those types of things. Superannuation investments, we handle that. We do have an experienced investment team here that they're not just myself, but we've got a whole dedicated investment team that helps us manage your retirement investments. That includes direct shares, ethical investing, if that's what you're looking for as well. And then probably the other one is on the far left, legal requirements, wills, estate handling. We can manage that through our Apt Legal service as well. And then, we do have other aspects of making sure that, retirement plans are going ahead in a timely manner, that your cash flow is managed, that if you are entitled to government benefits, that we're maximising those. So pretty much we can handle A to Z of whatever you're needing to advice on in retirement, not just solely superannuation, but all aspects. Okay, the other part of Apt is that we have over 3,000 families that we've helped through the journey of retirement. We've over 3 billion, it's actually closer to 3.4 billion now in retirement assets and funds that we manage for clients in retirement. We do partner with a number of charities, and we have also been awarded a number of awards for the service that we provide to clients. We are located up the eastern side of Australia, so Melbourne, Sydney, Geelong, and we've got a number of advisors that specialise in self-managed super funds across the practice, myself included. So now you've taken the first step. Let us, if you want to then take those next steps, which I'd suggest that you think about what it is you want your retirement to look like, and then engage ourselves. You can contact us, our phone number, our email address below on this there at info@aptwealth.com.au. Also, our website's got a lot of collateral there, a lot of marketing material that will help. in your decision making. And obviously, we've got advisors here at each office that can help in make your decision to retire, hopefully as painless as possible and give you ultimately peace of mind. That's the presentation. I'll just double check if there was a couple of questions put up here. There is one that I'll just briefly touch on. And I think the question is around contributions to super. And it looks like the 120, so the non-concessional, I believe, and the downsizer contribution it relates to. And what it seems to ask here is, my gist of it is, can you do both? So if you've got the 300,000 from the downsizer contribution plus the 360 from just the non-concessional, that personal contribution, you can actually do both. So the 300,000 downsizer contribution, if you meet that criteria, it doesn't go to that contribution cap. So for an individual, a single person, they could put 300,000 being a downsizer contribution, plus if they had more money, 360 from a personal contribution. So 660,000 could go into superannuation. And then obviously if that's a couple, you've got 660,000 each. So that's quite a lot that you can get into super in a relatively short period of time if you meet that criteria. That would take you up to, as a couple, or say an individual, obviously 660 plus whatever's in super, a couple, over 1.2 million that then can be converted to a pension tax-free in retirement, if that's part of your strategy. That's it for today. We are going to continue doing more webinars in each month, so keep an eye out for those. A Division 296 webinar, going back to that tax that's likely to come in for a pension, balances above $3 million. We are looking to do one of those, so keep an eye out for that if that impacts you and you're interested in that. But we'll be in contact and marketing that out to people that's on our contact list about that. Any questions, reach out, and have a good rest of the day. Thank you.